Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this video, we're going to talk about one key principle you need to master as it relates to being successful in stock market investing. Every year, literally, there's this embedded principle that if you master it, you'll greatly increase the probability that you'll achieve your long-term objectives with your stock portfolio and your overall investment portfolio. So you'll enjoy this video. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time, quite literally in all aspects of retirement. And so if you don't want to miss future installments of our stock market investing video series or other content that we're creating on a regular basis, make sure you hit the subscribe button. Now, this first chart I want to show you looks at year-by-year fluctuation in the U.S. stock market, the S&P 500, from 1980 all the way through to 2014. Now, I'm going to have another chart that looks at 1970 all the way to 2020. But let's look at this one-year chart. Now, what is the wisdom embedded in this particular chart? It's extremely important that we master this concept. And you want to keep this in your back pocket as a stock market investor to help you to be disciplined with this part of your portfolio. So we know that there is short-term volatility in the stock market. That's what makes it hard to invest in stocks, because when you go through that fluctuation, it can be very, very unnerving. So let's look at these various components to the chart. So the red dots you see every single year, okay, all the way across this chart. Those red dots represent the worst return within the year. So at the maximum drawdown rate in the market, where was the S&P 500? Now what you see with this chart is that every single year had a negative drawdown. So the intra-year return was such that at some point there was a negative return, even though the blue bars, which represent positive years, you had years where the market was down, but by the end of the calendar year, the market was in positive territory. Now the other bar you see, the orange bar, is negative years, where the market finished in negative territory. Now when you step back and look at this chart, the first thing you should recognize is that, number one, every year had a negative intra-year return. Number two, there's way more positive years than negative years. We often talk about, in general, we don't know the timing of these drawdowns and increases in the market, but 70-75% of the time the markets can be positive, 25-30% of the time the markets can be negative, generally speaking. So out of a 10-year period, you can count on the fact that there's probably going to be 2 to 3 negative years and 7.5 years positive, and we don't have a crystal ball to know precisely what's going to trigger those drawdowns, right? That's what makes stock market investing. We get compensated well for the uncertainty of the market in the short term if we can hold on to the assets longer term. Now, I'm going to use one example. So every year had a negative year. Let's go to 1987. 1987 is a very interesting year. The market, you can see, in a very short period of time dropped, in the mid-30s, minus 30-some% in that year. And I'm going to tell you a story about what happened in that year, because I was working for a trust company, and I worked at a client desk, and we handled guaranteed investment certificates and cash accounts and mutual funds at the trust company. So what do you think happened when the market went down very quickly? Well, there's a lot of unsophisticated investors, first-time mutual fund buyers, and when the market went down that quickly, I remember showing up in the office and there was a lineup at the door, and people were just hustling into the branch to try to cash out their investments in the mutual fund. I'm not sure why they were rushing so much, because whether you did it at 10 o'clock in the morning or 5 o'clock in the evening, you got the same price with the mutual fund. But anyway, nonetheless, they wanted to get out of the mutual funds, and then they ultimately wanted to buy a GIC. So you had a whole bunch of people here bailing out at this point, taking the loss on their portfolio, and then never recovering, at least for that year, because they went and bought a GIC. Now, what was interesting is we were in the last quarter of the year, and by the time we got to the end of 1987, the market was in positive territory. So it's actually positive. So you had a whole bunch of people that took losses of 25, 30+%, never recover from those losses. And those people that stuck with it, what happened is the next year was very positive, and the next year after that was very positive. In fact, any investors who had the discipline to add back here had an exponential growth in their portfolio over that time period. So that was a very instructive lesson for me personally, to see how the markets can whipsaw in the short term, and how panicking in the midst of that market's not necessarily the right high probability decision. Now, we do have 1 year here that was particularly difficult. That's 2008. And the market was down very significantly in that year. And it finished in negative territory, obviously. But what we saw happen was some pretty strong recovery after that point. Now, 2009 was very difficult because the first part of 2009, we had a continuation of that negative drawdown in the stock market. But after that, things began to stabilize and get a lot better. The main thing I want to show you in this chart, right, just step back and go, okay, if I'm going to buy stocks, then I know that in general, I have to anticipate an intra-year return that's going to be negative. I'm not going to panic about that. I'll hold on to quality investments I have in my portfolio. I may even use that as a buying opportunity to go back into the market if it's a significant drawdown. Okay, so that's the first slide I wanted to share with you. Now the next slide basically takes it over a longer period of time. So again, it's this 3-year average compounded returns of the S&P TSX. Now I'm showing you the Canadian market. And embedded in this chart is something that I say to clients. Now, I don't often use the 3-year rolling average. To be cautious, I use the 5-year rolling average. But the basic idea is to say, listen, when you put money in the stock market, time horizon is really critical. The longer you can go without needing the money, that your time horizon is 3, 5, 6 years or longer, then you can deal with short-term volatility because typically the market's going to start recovering. And that's what this chart's showing. So we're going from 1970 to 2020 on the far side of this chart. And what you see is that almost every single year over that time period, with the exception of 1, 2, 3, 4, 5, 6, 7, 8 years, the 3-year rolling average was positive. It's pretty incredible. So if we can hold on for a 3-year rolling average, treat it like a 5-year GIC, the probabilities are in our favor that we'll be in positive territory. And we look back at it and go, well, I probably would have gotten the same return had I just stuck the money in a term deposit for 3 years. It's one of the reasons why I recommend to clients, again, treat it like a 5-year GIC. What are the rates for 5-year GICs? The expectation is, and it's not an unreasonable probability, that even if the market does poorly, the worst that's going to happen is you'll probably have a return that might be comparable to a 5-year GIC. That's not what your goals are, right? That's not why you invest in the stock market. But if worst case isn't going to be too far away from what you would have gotten in a term deposits, then get the money working for you. Now again, that works when your time horizon gets extended out. It doesn't work if your time horizon's the next year. If you put the money in the stock market and you need to pull the money back out in 6 months for a down payment on a house or a trip that you're taking, then don't be surprised if you get caught in a situation that unexpectedly market goes down. Now you're in a loss. Now you're in a difficult situation. Do you pull the money out at this point? Now, if you look at the averages here, this is interesting. So the best 3-year rolling average was an incredible 34.7% in 1980. The average over that time period was 9.5% as a 3-year rolling average. And the worst was minus 6.3% in 2002, so this time period here. But again, when you look at the numbers, the probability is number one, expect volatility every year. At some point in the year, you're probably going to be in negative territory. But normally, the markets will recover to push you into positive territory. Not a guarantee, but that tends to be what the trend is. Number two, as you extend the time horizon, then that volatility over a 3-year period gets greatly reduced, right? So those are really the two messages I wanted to make sure that you took away today. Even for sophisticated investors who sometimes forget about these numbers. But the most important thing when you take a look at your portfolio is expect that intra-year volatility. It's probably going to happen, very high probability. Don't get unnerved by it. And in fact, use that as a cue, not to move out of the market, but to try to find assets to potentially move more money into the market to take advantage of the buying opportunity that's there and to seize that opportunity as we go into recovery. Well, it's my hope that you found this video helpful. And if you don't want to miss future content on this stock market investing series or other content we post on a regular basis, make sure you hit the subscribe button. Now, with this video, you'll find links to our webpage for other helpful resources. And we're asking people, if you have questions on various topics of retirement income planning, make sure you go to our website. You can send an email to us suggesting a topic you'd like to see covered, and we'll try to get to those topics for you. There's also links to our retirement coaching page. There's some really helpful resources on that page, and as well information about our coaching services for those of you who are getting close to retirement or would like a second opinion about their retirement planning who are already retired. Anyway, wishing you all the best in both your wealth planning and retirement planning journey. You take care.